Hi everyone. So in this video we learn about exchange traded funds and how it is different than open-end and closed-ended funds. We'll first take a look at the other two categories. So we'll first talk about open-end mutual funds. Open-end mutual funds involve directly transacting with the fund for creation and redemption of shares. The buyers pay cash equivalent to the net asset value of the fund, and in return, they get a share of the mutual fund. That is, a share of the pool of assets that the mutual fund holds, which can be cash, securities, bonds, shares, and other investments. The mutual fund has to process all the creation and redemption requests and hence keep extra capital aside for the redemption requests. For open-ended mutual funds, the money invested by the investors directly go to the fund manager, who can instantly diversify existing portfolio with new assets from the funds that he has obtained. The disadvantages of open-end mutual funds include that the number of shares vary with the creation or redemption request daily, and hence cash has to be kept aside to service these requests. Open-end funds are not traded in the market and hence lack liquidity for the investor. So we'll now talk about closed-end mutual funds. A closed-end fund involves a fund that has previously issued shares in return for cash provided by investors. The investors in this deal act as sellers who trade these in the secondary market. These shares trade every minute in the secondary market, and hence the price varies from the net asset value of the fund due to the market forces, that is, the mismatch between the number of buyers and number of sellers. The advantage here is the liquidity that the market provides as opposed to the open-end funds. As closed-end funds are traded in the market, investors gain instant liquidity as they can sell the shares on the secondary market and withdraw the money. Price is different than the NAV, which is the actual value of the fund, and hence you can either get it cheap or get it expensive. Funds raised in the secondary market do not add up in the fund manager's assets, and hence instant diversification is missed. Now think of a solution to solve all the issues at once: liquidity, diversification, and reduced price volatility. Can we attain everything in one product? The answer is yes. Finally, we'll talk about exchange traded funds. Exchange traded funds, ETFs, involve the same mutual fund, buyers who transact with sellers in the secondary market, and market price determined by market forces. The difference here is that the ETF assigns an authorized participant, that is, a big dealer or broker, that alone has the right to create or redeem shares of the ETF and transact in the secondary market. Take the example of a manufacturer who assigns a wholesaler or retailer to manage transacting with the crowd. The manufacturer just deals with one entity. The same goes for the fund and the authorized participant. Consider that buyers are more than sellers in the market. Buyers provide cash and the sellers sell the shares of the ETF in the market. With more buyers, that is more demand, the price of the mutual fund shares will go up and above the net asset value. The authorized participant in such a case sells some of its ETF shares at the high price in the market and bring the prices back to the NAV range. This arbitrage activity done by the AP normalizes the market price to the NAV. The authorized participant later buys the sold shares from the ETF itself for the NAV price by exchanging cash and securities. Now consider that the sellers are more than buyers in the market. More sellers would bring the price of the ETF below the net asset value, and investors would get it cheap. The authorized participant in such a case provides liquidity to the market by buying shares in the market at a lower price and then putting a redemption request to the ETF for the NAV by getting securities in exchange for ETF shares. The market price is again adjusted to the NAV range for the ETF. This resolves the problem of price volatility showed by the closed end fund. The three main parameters of mutual fund investing, that are low price volatility, high liquidity, and instant diversification, are all demonstrated by exchange traded funds. The available ETFs in the market are passively managed that track the indexes like S&P 500, Sensex, Nifty, etc. The only advantage of this is a low expense ratio. Guys, thank you for watching the video. Hope that it proved to be useful. And do like, share, and subscribe to my channel.